Hello and welcome to Building Tomorrow's Insurer, where we dive into what's happening in insurance and look into the future. And today we could not be more excited to be joined by, you could say, one of the most innovative minds in insurance, and that's Walter de Oude, who's the founder of Singlife, now exited, and now Chocolate Finance, and hopefully we'll dive into that a little bit today. And just give you a little bit of background. Walter built, I think, maybe one of the first digital insurers that really redefine how customers interact with their money. Is now scaling an asset management company, and we'll try and spend a little bit of time today to understand his story, understand challenging legacy models, and maybe capital constraints, pain points. I think if there's anyone to talk to that's done it in the world of insurance, Walter's a good man. So I'm really looking forward to the conversation. So Walter, look, thank you so much for your time today. I'm really looking forward to it.
No worries, Nigel. Happy to hang around for a chat and tell my story and give my pearls of wisdom to anybody that's willing to listen.
Awesome. Love it. Maybe I think a good story always starts at the beginning. And so I'm interested in understanding your journey from the beginning. Obviously you were an actuary. Yeah. And then became a founder, and so not just a founder, maybe one of the most successful, I think, innovative insurance businesses in Asia. And so, can you talk us through that? Can you talk us through the journey from actuarial world into founder life, and then like founding a business?
Yeah, sure thing. Well, first off, I'm a South African actuary by training. Like all good South Africans, at some point in your life, you say, we want to get a bit more international experience. So I was working for Swiss Re at the time. Mm-hmm. This was about 2000. And Swiss Re had a job for me in Singapore. So I spent some time with Swiss Re here. Then spent some time with Swiss Re in Japan as the actuary for Japan. And then I moved to India in 2003. As the actuary for India for some time, and then decided I wanted to be a consultant. Came back to Singapore with Towers Watson at the time.
Walter, sorry to jump in. Why go from actuarial to consultant? What was did you just think, I just want to try out and see what this consulting gig's all about?
Yeah, well, I'd been with Swiss Re about 11 years at that point, and I had done some work with the Towers guys before, or the Watson White guys before, and we wanted to get back to Singapore because we kind of liked it here. And there was a gig here, and so I did that for a while. But I realized after about 2 years of consulting that I'm a shit consultant. Actually, I'm quite a good one. But my particular kind of consulting was less around crossing T's and dotting I's, and more about telling good stories and just talking. So I realized that actually I wanted to then be a little bit more practical. So then I left consulting and joined HSBC as the actuary for the insurance businesses here in Singapore. In 2007 odd. So I was appointed actuary and product guy for HSBC. And then I took on, I didn't mess it up completely, so they gave me the CEO job in about 2010. So I was CEO of the insurance business on the global exco for insurance. I was on the executive of the bank. I was a director of the HSBC's asset management company, and did all that for about 7 years until about 2014. When I decided that Singlife would be a good idea. Actually, what happened was I had done a reasonably good job with HSBC, and my next gig inside the HSBC world was to go and run the HSBC France business, which was the second biggest after Hong Kong in the HSBC world, which would have been a really nice, fun thing to do. Challenging times in France at those particular points in time. This is 2014. With interest rates and things, but I decided actually, and it was like now or never. If I was going to start something on my own, I had to just take the plunge and give it a go. That was 2014. That was the beginning.
And when you make it sound very simple, starting an insurance business, but there's no small feat, especially in a place like Singapore, which has a pretty regulated environment, and so. What were the big challenges like when you kind of made that call and say, hey, cool, like let's kick this off, let's start this business? If you had to transport yourself back, what are these Obviously, there's a bunch of founders listening to this pod, and starting can sometimes feel very overwhelming in terms of the large challenges that are in front of you. And so, can you maybe talk to me about that? What were some of the really big hurdles you had to overcome?
Yeah, sure. Well, the first one, I guess, was having a backup plan. I guess because founding is tough, and it might not work. And so, people always say you should take risks when you're young. I think that's rubbish. I think you should take risks when you can afford to take risks, or when you're more likely to actually be successful is when you've actually been around the block a few times and you've seen how things work, and you're more likely to be successful at it because you've got more war wounds that make it more possible. So my theory was really, I'd done a good thing in the blue collar corporate life thing. I could manage those kinds of businesses, and if it didn't work, I could always just go back and get another job. That was my theory. And obviously, having a good long career with big organizations, you build up a little bit of capital so you can survive a couple of years in case you need to, because there's going to be some years in the wilderness as you go down the startup path. And starting an insurance company, like you say, I mean, it's not a small thing. It was a reasonably crazy idea at the time, and looking back now, would I do it again? Well, maybe. But it took a long time to get it off the ground, and I can talk you through all of those little steps along the way. But it was a big, challenging time.
Yeah, for sure. And what were some of those steps? Like, you got to make the call and go, cool, I'm going to do this thing. Was it getting like regulatory licenses? Was it finding team? Was it getting capital? Like, what were they? How did you, like, were they?
Yeah, like all of the above, man. All of the above. So, look, I think the first thing you've got to do before you leave your big cushy job, you have to kind of figure out, well, are there enough ingredients there to make this a possibility? And the first thing was licensing and regulators, right? So, and I remember having a discussion with a regulator in Singapore. It sort of been about the end of 2013, kind of saying, well, I'm keen to give this a try. And the licensing comes in three parts, right? The first thing is, what is your track record? Number two, what is your business model? And number three, how you capitally funded? Now, under the regulations in Singapore, to start a term life kind of insurance company, the regulated minimum capital requirement was $10 million. And we went and said, okay, well, let's have a chat about this. And said, we're going to start a life insurance company. And we first spoke about, experience and background. And so it was me and a kind of bunch of guys that were with me through my HSBC career. That kind of CFO, chief underwriter, those kinds of people, one or two techie guys, all the regulations around experience is all kind of designed like a big Prudential coming in from the UK. And so you talk about your corporate background and the credibility of Prudential coming in to start a business in Singapore, but we were individuals, right? And we said, well, collectively we have 50, 60 years of working in the insurance industry. Is our credibility or our pedigree good enough? And the regulators said, well, let's go, we'll get back to you. And a couple of weeks later they said, yeah, no, we think we'll support you if you wanted to give this a go. And they said, yeah, but the issue is capital, right? I said, although the regulatory minimum capital was $10 million to get started, they said, well, that's designed for a subsidiary of a foreign company coming in. And if you wanted to come and start this, we'd support you, but you need more capital. I said, well, how much more? And they said, well, more. And I said, well, is it 20? Is it 30, 40, 50? And they, yeah, 50. So I said, okay, I'll come back when I've got 50 million. So then that began the journey around how to raise $50 million. And so you've got this beautiful conundrum of raising money. Now, when you're raising money, and normally when you get investors to support a business, money comes behind the ability to make money, right? And so normally an investor puts money into a working business model, proof of concepts, all that stuff. So we had this issue where we couldn't raise money because we didn't really have a working business model and something to show for it. We had a really good PowerPoint spreadsheet. And then we couldn't get a working business model because we didn't have a license. And we didn't have a license because we didn't have $50 million. Yeah. And we didn't have $50 million because we didn't have a working business model, didn't have a working business model because we didn't have a license, didn't have a license, didn't have money, et cetera, et cetera. So we spent about 3 years figuring out how to get the money, and it took 3 years. Wow. During that course of time, we pretty much self-funded ourselves. We had a couple of angels that came in along the way, raised about $2 million just from angel type of things in those first 3 years. But we must have changed shareholders, or through that process over 3 years, had obviously 200 type of investor engagements, and actually engaged with the regulator with almost committed capital in 3 different sessions, and 3 out of the 3 or 4 times. Fourth time it actually got through it, but we actually went through capital structuring with the regulator a number of times along the way. 3 times it fell through. 1 time we got it done, and we got all the capital in 2017, and got our licenses, everything kind of end of 2017, so September 2017, and off to the races. That was the story.
Super interesting. And you read a lot once you kind of got going, and often founders will focus on product. And I think when you look at really successful businesses, a lot more focus on product, but also distribution being like ultimately, if you can't make a sale or get to a customer, it doesn't matter how good the product is, no one's going to buy it. And so I think kind of that's something that you have focused on early a lot. Can you kind of talk to me a little bit about that, around maybe why that was your biggest challenge, and then what did you learn about distribution in insurance, and where did people get it wrong, and where did you get it right?
Yeah. So you're absolutely right, I think, and this is not just an insurance story, it's an every new business story. The focus has to be on how you're going to sell your stuff, not how you're going to build your stuff. I think there's too many founders come up with a really good new mousetrap or a new widget or a blockchain nonsense, this or whatever it is, some new way to skin a cat. But unless you can sell it, unless you can put petrol in the car's not going anywhere, right? So it has to be around defining a certain target customer segment, building a product around that particular need or that particular customer segment, and then figuring out how you're going to sell that. And in the Singlife story, this was 2017 roughly, or 2013 was the beginning of it when the ideation happened. But at that point in time, there were 2 specific use cases for a new insurance company in Singapore. In Singapore specifically, number one was the whole digital access. In Singapore, we had always had an advised model, either agency, financial advisor, or bank insurance type of models, commission-driven, commission style of products, and there was just no direct access stuff. And we said, well, we think that the direct access for life insurance is an important mechanic for distribution. I think there is a specific target customer segment which would prefer to just self-purchase. And we built out a self-purchasing capability for life insurance, and that was complicated in and of itself. You've got digital onboarding, which today is kind of easy. Like there's 20 million different digital onboarding pieces of tech. When we started, we had to build it all from scratch because it didn't exist at the time. Digital underwriting, plugging in whichever reinsurer's stuff you can plug in and do it in a digital way. All of that had to kind of get built out. But there was this idea that there was a market for direct distribution, and if you could cut out all the costs associated with traditional distribution, you could actually deliver a more efficient product, which was really the basis on how we did it. And people say, well, why do you think this will work? Don't you think all the other big businesses will just copy you? If you go digital, why can you stand out against an AIA or a Prudential or whatever else? And I said, well, it's very simple. If you've got 99 or 90% of your business is distributed by advisory or agency, you're not going to be putting a digital product on your platform because all of your advisors will freak out, right? You're not going to cannibalize your own base, and so no one's going to compete in this space. Where Singlife had the ability to stand right up and just say, well, we're going to do this head on, and we knew that we wouldn't face that competition in the early phases. So that was number one, around distributing digitally. The second thing in Singapore is this kind of destination for wealth, right? So much money was coming into Singapore. At HSBC, we had built a cracker business doing high net worth insurance, so universal life type private bank constructed stuff. And so that was the second arm of the Singlife proposition was how can you leverage the Singapore stability framework for selling universal life type of products through private banks, which had its own challenges because most of those types of products are finance products. You need credit ratings and all that other stuff. But there was a real opportunity to do that, which we did as well, but more challenging than the digital space. But we got quite a lot through on that space as well. That was the defining rationale and the business plan. Those are the two segments that we went for and built the business around those two.
Interesting. And with the digital direct, did you have to think about specifically the age of the customer? Did you kind of go, like when you're thinking about who you were targeting there in terms of that digital distribution, did you kind of skew to younger in terms of like customer segment?
Yeah, so for any kind of new business, you know categorically that you're wanting to serve the broadest possible audience you possibly can,
Yep.
right?
Yep.
But when you have something new, you always face an initial challenge is who's going to be your early adopters.
Yep.
And who's then going to be your advocates around the business, and then that advocacy then translates into a broader, deeper penetration.
Yep.
In the Singlife world, it was much more generic because who needs life insurance? It's people between their 30s and 50s in particular, and pushed it out in that space. Then you're hoping that it's going to generate a little bit further. When we did the chocolate story, which I'll talk about a bit later, it was much more. We chocolate is designed around very stable, safe, cash-like savings, but it's to get that initial and that stable cash-like savings is actually for lazy savers, right? Lazy people that just want to, now I've got money in the bank doing nothing. I'm just going to put it here because I get something more. But it's such a generic, easy product, but not everybody trusts that up front, right? So your initial customer market segment is actually not your lazy savers. It's your maximizers, right? So maximizers are coming in for how can I get an extra half a basis point of extra returns, and you focus on that particular distribution segment so that you can then get advocacy around the product because those guys are the most vocal in talking about how good something is, and then that's where to get access to the broader market that you wanted to have. So in Singlife's case, was just around pure digital stuff. There is a digital native user group, right? And those come through forums and all sorts of places where you can start talking about the digital advocacy, and that then kind of grows and grows as you build out.
Interesting.
That's how we did it. But the second fundamental of what we did was we focused a huge amount on brand. Brand as a marketing tool, more so than product. Yeah. Of course, the digitization of things was part of the brand. But what we did was we were lucky enough to have the name Singapore Life, right? And people ask, how did you get the name Singapore Life? And the answer is, well, actually, in Singapore, when you start a company, you go to a register in an online thing and you say, type up a name and you want to push search. And I put in Singapore Life and I put search and said available. So I said, okay, buy, paid my $200 and started a company called Singapore Life. But the digitization of everything that we did was, we went from Singapore Life to Singlife very quickly. It took Manufacturers Life Insurance Company of Canada about 40 years to go from Manufacturers Life to Manulife, but it took us about 12 months. These branding things happen. And when we started the brand, I don't know if you recall, the original Singapore Life brand was a big lion's head and big black and red bold block lettering, right? We specifically built it so that it would look like a brand that had been around for 50 years. It was designed to have this kind of stability. It was in red and black. Now, if you've ever done an MBA, and not that I have, but they say that if you ever want to start a 5-star hotel, what's the best location to put your 5-star hotel? And the answer is very simple. You put it next to all the other 5-star hotels.
Yes, so yeah.
That's where they are, right? And so if you want to be an insurance company, you go and be exactly where all the other insurance companies are, which is black and red lettering and lions in your logo, right? That's how you do it. Because
feels stable and big and like trustworthy.
Exactly.
And yeah.
Exactly. But after about a year and a half, we realized that actually there was this kind of dichotomy between the stableness and brand we were originally trying to get and the digital advocacy and the newness and freshness of distribution, which the Singlife story represented. And then so we changed the brand and dropped the lion and dropped the old black lettering and changed to what we now called the Singlife Burst, which was the more digital representation of what we were trying to do. But that early phase of branding was very, very useful in getting us the pedigree to where we need to do. Only successful companies rebrand and live on. So that was part of this life journey.
Yeah, you've got to get to that point, haven't you? You've got to survive long enough to get to the point where you can rebrand. Or exactly. Or you can maybe just launch 5 times until someone actually realizes that you've launched, and maybe that's just as good. When you were thinking about distribution, did you build partnerships? Was partnerships part of your distribution strategy, or were you just very much direct to consumer, and that was it?
Yeah, when we started, we thought, look, the world is going to change. We're going to kill agency. Life's going to, digital is the way forward, and you just build a digital business. And so we didn't bother really with digital partnerships. We did think about it a few times with, the integration into third-party ecosystem type stuff, but actually it was just too hard. And relying on someone else's brand and distribution that way had so much effort and requirement on our side without the control that we would have ordinarily liked. We just focused it on ourselves. But when we built the digital proposition for Singlife, it worked fantastically well for the get-go. It just went like this, right, straight off the cuff. But what happened was after about a year, it kind of plateaued strangely. It kind of goes straight up like this, and then all of a sudden, without warning, it just goes flat, right? And you realize actually that you run out of digital native customers. Because not everybody. Those
early adopters have come on. Those early adopters are in.
You get that, and so you then realize actually we had to pivot a little bit. And there were 2 things that we did quite successfully. The first was we acquired Zurich Life in Singapore. So Zurich Life was leaving, and they had about 25,000 customers with basically term life and a bunch of investment-linked product. And we basically assume their portfolio without paying a lot of money for it, which gave us a nice big uplift and a boost, and that kind of also widens your referral networks and other things through the customer base. But the second thing we realized was actually that at this plateauing of the digital direct stuff, it was the time to re-engage with third-party distribution. Because we had built a really, really slick onboarding and execution platform for delivery, we thought, we've delivered a digital proposition to direct customers. Why can't we use the same digital onboarding capability and use that with third-party financial advisors, not agency, but third-party financial advisors, right? And so to actually help a financial advisor to sit down with his customer and sit down and go through a needs analysis and then close the sale in digitally, boom, 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 done in minutes, rather than the traditional insurance approach, especially for third-party advisors where they're dealing with lots of different companies, to kind of fill out a bunch of forms, send the forms in for an underwriting, get a result back, and then re-engage with the customer. That ability for us to get with digital, get with financial advisors and offer them a digital offering, allowed them to close sales really quickly. And the good advisor knows that the quicker you can close the sale, the more likely you are to get it done, I suppose. So if you don't have to go back to the customer, get it done in one go, you're much, much more likely to get it closed. A lot of the time insurance is a hard thing to sell, right? And if you have to keep going back to the customer for more things, the more likely is that your closure rates go down. So we got a very high closure rates on this and got a lot of third-party advisor engagement around that. So that was then the pivoting from a purely digital play to a digitally advised play as we started to build it out. Yeah.
Interesting. And did I read something around kind of banking as well in terms of a product that was linked to a debit card or something like that? Did you do anything like in the bank assurance style space as well? Yeah.
Well, you talk about distribution in its broadness, and of course, the holy grail for life insurance companies, can you sign yourself a nice big bank assurance deal? Can you in Singapore, Manulife and DBS have the biggest bank assurance partnership here, but Manulife paid $1.2 billion to DBS to get that deal, right?
So they just spent that as a choose us and we'll give you $1 billion.
Correct. And then you can, they get the exclusive rights to
Yep.
distribute their product, and
Got
it's
it.
not a bad way. You get a lot of volume that way because the banks have to sell. But of course, as a startup business, we never had $1.2 billion lying around. So
Lying around? No. It's hard to raise 50 mil, let alone 1.2.
exactly. So at the time, I thought, well, of course, I can't get a bank insurance deal. So why don't I just build a bank? And so what we did was we took a view that, look, everybody's got cash in the bank doing nothing, right? Can we build an insurance product that works pretty much like a savings account, and we can build a banking product for customers, which we can then farm for customers' use? And it's a distribution thing, right? And the theory is if you can get as close as you can to a customer's cash, you can then sell them other things in the hierarchy. So cash to protection, to health, to cars, to investing, to whatever else, yeah? Mm-hmm. So what we did was we built a product. It was an insurance product. It was a universal life construct. So it was a variable, right? So you can put money in at any time. You can take money out at any time. We give you an interest rate or a crediting rate on top of that. And built a cool app around it. Put a debit card on it so that you could use your debit card to actually withdraw money from your insurance policy. Built a cool app that kind of looked like a bank, spoke like a bank, talked like a bank, and there you have it, right? So you have an interest-bearing account, which does what a current account would do, with a debit card mechanic, which made it look bank-like, and we generated returns for customers, and that worked really, really well. We put about 100,000 customers and $1 billion on that platform in about 7 months.
And so sorry to interrupt there, Walter. This is so interesting. So there wasn't actually an actual bank. You were just really there putting the premium in an account that
Correct.
then the customer could then access. And so then you kind of took reinsurance out on the back end. That's no reinsurance.
No. So we ran it. We basically ran it like a short-term fixed income endowments, right? So it's
okay.
You're backing it with short-term bonds, and we did exactly this. So this is the story of Chocolate, right? Chocolate Finance is actually the version 2.0 of the Singlife account.
Sure. Okay.
Of what we did there, because it's this very simple customer need. Everybody's got money in the bank doing nothing. Everybody, you, me, your mom, your brother, everybody's got this problem. And what we wanted to do is have an engaging digital direct product, which we can then use for branding, use for marketing, and build a whole story around. And that worked really, really well. Like even the debit cards, right? We knew that the debit cards would not really be used because, cards is a difficult business, right? It's debit cards especially, because interchange is different from credit and such a competitive market on mileage and cashbacks and all that stuff. But putting a debit card on your insurance product made it look like a bank. And it did what banking things do. And so you got this instant bank-like credibility that came from that. And that's what made it work so well.
And it also feels like
it's the same thing. Yeah.
That's all. We're going to jump into chocolate. This is interesting. And it also, I suppose, makes it feel like your cash is accessible, even if you don't access it. Like it is accessible, but you knew that really customers aren't going to use that as their transactional account really, but it gives the customer a real feeling of this trusting relationship between where my cash is sitting and I can access the funds.
Exactly. That's exactly right. Yeah.
Wow. Very cool. And before we jump into chocolate, I just want to go one last part of the Singlife story. And that is the moment that every founder wants to get to, which is an acquisition moment. And so, but obviously very few get to acquisition, and even fewer get to an acquisition the scale of the Singtel acquisition. And so I'm interested in, did you always have a plan? Was it you were raising capital and actually Aviva came in? Was it that you'd had strategically thought these are the kind of folks that might want to acquire this asset? Can you talk to us about how you thought about it and came around?
So the Singlife business was growing very, very fast, and we needed new capital, right? And so, and this is led a lot by the Singlife account that we had built. Because it was an insurance product, it worked really, really well. But because it was an insurance product, it attracted regulatory capital. And roughly, for every $1 of customers' money we put on that platform, we had to hold about 7 cents in regulated capital. So at $1 billion of balance sheet on that product, that's 70 million of reg cap, which means that the product is not scalable. It was still scaling, but our capital was was finite, right? So we had to then go out and raise capital, which we were in the process of doing. What happened was this was end of 2019, 2019.
Wow, it's quick, isn't it? From 2017 launch to 2019 being at that kind of scale. That's
it was
a
quick.
big growth story, yeah.
Yeah, it was. But so Aviva, for whatever reason, was exiting Singapore. Right, they were selling out their business, and they'd gone through a process. Hired a bunch of expensive bankers to try and make as much money as they can out of selling their business. When this was happening, then we thought, Chairman and I thought, well, why don't we just buy Aviva? And so we constructed a mechanism that we could figure out how we could do it. And I'll explain in a bit, but we then try to get ourselves into this process to get on the Aviva acquisition thing. And we kind of got into the process a bit late in it all, but we weren't able to conclude it just given the amount of information and time that they had set themselves to do the transaction. And when they did run out of time, then they failed to actually get a buyer. And so when that process was over, I called them up and said, look, we were never really actually in your process. We are still willing to buy Aviva on the terms that we had agreed. And but we're only willing to do it on a bilateral basis, so no beauty parade, none of that. So they said, okay, good, this is the end of 2019. And so we started on that process. Of course, 2020 happened, and we had our favorite little COVID incident. And of course, by that time, it was all pens down. And so we then had to kind of raise new money for keeping our our Singlife account business growing. But by about May of 2020, I called them up and said, guys, it's now or never. We either do this deal or it's never going to happen. And they said, are you still keen? They said, yes. I said, okay, fine, but the price is X% lower than it was last time around. So anyway, we did it. So we did this transaction where we acquired Aviva in a structure. What we did was we raised about 750 million. So actually, say it like this. So the Singlife business that we'd built, we valued it at about $500 million. The Aviva business was valued at about 2.7 billion. So together, that's 3.2. Yeah. What we then did was we borrowed $1.2 billion, which was done in a 300 and something million senior debt layer with the bank. We issued a $550 million bond, and we did like a buy now, pay later thing with Aviva for about $700 million. We raised $720 million from TPG on the private equity side. We raised another $300+ million from Sumitomo Life, who had been an earlier investor of ours as we raised capital along the way. And we rolled 25% of Aviva's equity into the holdco and rolled everybody else up together into one big ass structure. So set up a new holdco, put these two insurance entities together as subsidiaries, and then merge the two underneath. Right, that was how we did the whole transaction, which was a pretty amazing piece of work to be done during COVID, when no one actually went to work. So we did that. It took us the whole year to complete that. We did that behind closed doors, directly between us on the Singlife team and the Aviva London team, and completed that at the end of 2020. And that was where that kind of came to bear. And so through the course of, but of course, sometimes you get what you want and sometimes you get what you need. And in my case, I'd kind of put this deal together as acquiring the Aviva business, and I wanted to take this massive chassis and just grow it out further. But what actually happened was, once we'd done the deal, there was quite a difference of view between myself and the private equity owners or the majority owners of the new business around the direction of travel for the business going forward. I was a growth, reinvest, build kind of guy, and private equity, as you know, is a bit more
extract value.
Let's extract value, and so there was a real difference of opinion, yeah. So what they did was they took the Aviva former CEO and put him as the CEO of the go forward business, and I got promoted to the board. So I sat around as the deputy chairman for a while. And as part of that deal, then I took out a bunch of equity. Didn't have too much to do other than be bored on the board. Started to invest in a little bit of this and a little bit of that, and then you started to pave the way for chocolate to emerge as a new business in the next thing. What I did do also was I started a little venture company, venture fund, because I thought, well,
Chocolate Ventures, yep.
Chocolate Ventures, yeah. So I built that, set up the whole fund, started writing checks, right? Because everyone thinks, founders, he's got some money, he can put some money to work. And I thought, well, this is easy, right? It's just, you just found a business, you throw some money at it, and off it works. But I realized over the last kind of 3 years that I'm not a good investor. I'm far too optimistic and far too, everything that glitters is gold in my world, right? So I have made some investment mistakes along that way. I mean, there's a couple of jewels and the things that I tried which will actually work okay, but it's the standard, 90% of stuff dies and 10% of stuff wins. You just hope that the 10% of stuff is enough to
big enough
to cover it off. It's a time consuming. If you really want to do investing in businesses properly, you have to be set up for it, and it has to be a full-time activity, right? You can't do it off the side of your plate. So after doing that for a while, actually, no, this is rubbish, and so I stopped doing all that, and I just focused completely on the chocolate business, which we've been building ever since.
Love it. And that's the perfect segue. Can you bring us up to speed on chocolate? You mentioned obviously it came from the work that you did at Singtel and the account. So can you bring that to life for us? Yeah.
Yeah, so look, it built on the same principle that I spoke about, the Singlife account, which was this cash generative product. The big downside of what we had built at Singlife was the capital restrictions around an insurance product. So the theory was, are you able to provide a value-added product to customers which people will actually use? And we'd proven that they would use it in the Singlife context. Can you do this again in a capital light fashion, right? And so this time what we did was we built chocolate accounts or chocolate finance as a business, just to give you in theory, a better return than you'd get on a fixed deposit, but you'd be able to extract your money anytime. But in order to do that, instead of using an insurance license like what I did for Singlife, I'm now using an asset management license. And the big difference is fundamental, right? If you give your money to a bank or an insurance company as a depositor or an investor, you're actually giving your money to them, right? Your money goes onto the balance sheet of the bank or the insurance company, and they owe it to you as a liability, right? So all your assets are commingled with the banks or the insurance companies, and because of that, the banks and insurance companies have to hold this huge amount of capital. The banks and insurance companies are quite restricted in how they can invest that money for your benefit. But an asset management company doesn't have that problem, right? Because if you're putting your money with an asset management company, it's not going onto the asset management company's balance sheet. It's actually going into a separately segregated, ring-fenced, custodized account. The manager manages it. And of course, because it's separately segregated, there is no capital ring-fencing or capital requirements, which means you can scale it infinitely. And secondly, as an asset manager, you're actually unrestricted in how you can invest the money. So you can take durational and optimization, which is slightly different from how a bank or an insurance company would have to do it. Which basically means that as a chocolate finance enterprise, we can systematically, permanently, and forever generate better returns on short-term money than are available from an insurance company or a bank. That's how we built the thing, and that was the story behind it. And so, back to the drawing board on tech and all of that, but this time under a different license. And we just built a product called the Chocolate Account, Chocolate Finance. Why chocolate? I'll talk about that in a bit. But basically, money goes into an account, or it's a portfolio of fixed income bonds. We generate returns on it in a very, very predictable manner. Just set a target return based on the yield to maturity of the underlying portfolio, which tends to be about 50 to 60 basis points higher than what you get on a fixed deposit, but with instant access to that money anytime. And it's worked really, really well.
And so there's no connection to any insurance product. There's no kind of life insurance product. It's a purely a finance product.
It's a pure finance product, pure asset management. Yeah.
Interesting. And so why chocolate? Let's I can ask you questions forever. Why chocolate?
Very simple. Everybody loves chocolate. Chocolate makes you happy. Yeah. We want you to be happy about your money.
Yeah.
But it comes down to this thing about branding again, right? So, and this is stuff that actually came from Simon Sinek, if you've ever listened to any of his stuff about infinity and...
The why. Yep.
Yeah, that's
Start
some
with
of
the
his
why.
latest stuff is actually really good as well. But the idea really is branding. Branding goes into so many different categories. So you get safety brands, like a Singapore Life is a safety brand, or it's it's designed to make you feel safe. There are other brands, like a lawyer brand, like what or a consulting brand like a McKinsey, or these are name human beings. You actually putting your faith in an individual, and they built brands around that, Ernst and Young or whatever. These are human brands and human quality brands. You get product brands like in ABC Motors is a motoring brand, or in finance world, in Singapore you'd have brands like Endowus or Stashaway, which are the brand is what the product does. But my view was that the most successful long-term brands are emotive brands. And the best example is Apple, right? Apple doesn't sell apples. But when you talk about Apple, you get a certain sense of brand and a loyalty around that ecosystem. And it's kind of weird how that works. And we tried to do that with chocolate. And the idea really was, how can we create a financial brand that is engaging, memorable, and creates a loyalty or cult-like following, because it actually just delivers good product and it's a cool brand. And that was really the genesis behind how it all worked. So a lot of thought went into that, but that's how, yeah.
Interesting. And I'm going to ask you two more questions, if that's okay. The first one being, you've spent a bunch of time in banking, in insurance, now asset management. How do you think they converge or diverge over the next 5 years? Do you think those kind of three areas come together? Do you think they get further apart? I'd love to kind of get your view on it.
Yeah, look, I think traditional models are always going to evolve over time. I think banks have been banks for forever as this big, clunky, monstrous thing. Insurance companies are insurance companies. But in my old world of Singlife, I said, well, why can't an insurance company do bank-like product? And that was what we did. We built a bank-like product as an insurance license and blurred the lines, right? I'm doing it again now as Chocolate Finance. We're offering bank-like, cash enhancement type of product as an asset management business. We put a debit card on it again, and we've done it much better than I did it at Singlife as well, with rewards and partnerships and all that other stuff that comes together. So it actually feels much more banky. But if you look at financial services in total, you've got three things on it. Number one is I need to have my cash deliver something. Number two, I need to borrow something. And number three, I need to pay for something, right? That's basically financial services. And if you add insurance, there's an insure for something. But with the regulations have all changed or evolved, that now you can actually get regulated in each one of these individual categories separately. Right? So you can be an asset manager to take cash. You can be a lender to lend, and you can be a payments company to make payments, right? So instead of being a bank, why don't you just have three different licenses? And you can do all three things, and you can arbitrage between those things in a very neat way. Insurance is different because insurance is insurance. It's got its own. You have to be an insurer. I don't think I'd ever start another insurance company again. I think it's too hard. But in my future world, there's plenty of insurers that have caught up with the technology and capabilities around API connectivity to deliver cool product into ecosystem, because ecosystem is the play for everything now. What's financial services ecosystem? How do you acquire as many customers as you can and distribute financial products to them? But to your point, it's the kind of disaggregation of financial services and then cherry picking those parts of it which are useful and putting them back together in useful components. And that can be, you add all sorts of stuff to that: planning, advice, all of that. It's all kind of separately coming together in different ways.
And last question from me before I hold you for your entire day. So chocolate is just in Singapore. It's not a global product. It's a Singapore-based product.
We started it in Singapore, but we've just got licensed in Hong Kong, and we will be making announcements about 2 other markets soon enough.
tune in. Well, Walter, look, thank you so much for your time today. It's been absolutely fantastic. I really appreciate it. I know that everyone is at home is going to be listening to everything very intently. So look, thanks so much for your time. I guess best of luck with chocolate, and we'll look forward to seeing these announcements coming out soon.
Good stuff, Nigel. Thanks for hosting me, and always happy to chat.
Awesome. Well, look, everybody, I hope you enjoyed the episode as much as me. If you do want to watch the video version of the episode and see Walter and my heads talking versus just listening to us, pop over YouTube. You'll be able to see it in the description, links in the description below. And as always, if you want to hear more from industry leaders who are pushing the boundaries in insurance, please do check out our other episodes of our podcast series, Building Tomorrow's Insurers. So from Walter, from me, thanks, everybody, and have a great day.